Welcome to the Deep Dive, the show that cuts through the noise to deliver the essential insights you need to be truly well informed. The world of electric vehicles is buzzing, right? So much information out there. But today, we're giving you a direct route, a shortcut, really, to understanding one of its most compelling players, Rivian.
Yeah, they definitely stand out, known for those distinctive electric trucks, SUVs, and vans.
And that whole integrated ecosystem they talk about. Our mission here for this deep dive is basically to dissect their latest financial report, that's Q2 2025. We want to uncover not just the numbers, but, the strategic shifts they're making, the challenges they're navigating. We're pulling out the key nuggets, the surprising facts, straight from their own filing.
Exactly. Giving you that snapshot of their recent performance, their strategy, what lies ahead.
Right. Let's get into it.
What's fascinating is just how clear Rivian states their ambition. They position themselves as this American automotive manufacturer focused on category-defining EVs, but also the software and services covering the whole vehicle lifecycle. Their goal, accelerate the global shift to zero-emission transport.
And they really emphasize that vertically integrated tech, don't they, as a key advantage?
They do. Everything from their, advanced zonal network architecture to their in-house autonomy platform, it's all part of that core strategy.
Okay, so let's unpack the big picture then. Their overall financial health. We hear a lot about heavy losses, big investments. What's this report actually tell us about progress towards profitability, especially with those big goals?
Well, the report it definitely shows significant improvement in their net loss. So
Yeah.
for the 3 months ending June 30, 2025, the net loss was $1.115 billion.
Still sounds like a lot of money.
It is, but it's a noticeable improvement from $1.457 billion for the same time in 2024. But here's the real milestone, I think. For the 6 months ending June 30, 2025, Rivian actually hit gross profit break-even.
Wow, okay. Gross profit break even. That sounds like a really big deal for a company still in its growth phase. What does that specifically tell us? Why is it so critical?
Yeah, it's huge. It basically means that for every vehicle they sold during that 6-month stretch, they managed to cover the direct costs of making it. So think raw materials, direct labor, the factory overhead directly tied to production.
Okay.
It's a crucial step towards overall profitability because it shows their manufacturing is getting more efficient. They're not losing money on each unit before you even count things like R&D or sales and marketing.
Right. It shows a maturing production
For
capability.
real maturation.
Yeah.
And what about the top line? Total revenue. How did that look?
Total revenue grew for both the 3-month and 6-month periods. For the 3 months, it went up from about $1.16 billion in 24 to $1.3 billion in 25. And for the 6 months, it climbed from $2.36 billion to $2.54 billion. So positive growth there.
But the composition of that revenue, sort of how they made that money, also tells an interesting story. It relates back to how they're narrowing those losses while still pouring money into future growth.
Okay, let's dive into that then. The nuts and bolts of the core automotive business. We're talking R1T pickup, R1S SUV, and the electric delivery van, the EDV that you see Amazon using.
Right. And here's where it gets a bit nuanced. While overall revenue went up, the automotive segment's revenue actually decreased for both the 3 and 6 months ending June 30, 2025 compared to last year.
Oh, interesting. So less money from selling the actual vehicles.
Yeah, for the 3-month period, it dropped from about $1.07 billion down to $927 million. And for the 6 months, it went from roughly $2.2 billion to $1.85 billion.
That feels a bit counterintuitive given the overall growth you mentioned. What's the strategic thinking behind that dip in core vehicle sales?
Well, it seems like a calculated move, really. The report points to higher sales in the prior period, so 2024, of the first-generation R1 vehicles. They were essentially clearing out inventory, ahead of launching the second-generation models.
Ah, okay. Making way for the new stuff.
Exactly. And they also had higher commercial van sales back then. Now, this was partly offset because the average selling prices for their vehicles were actually higher this quarter.
Yeah.
And for the 6-month view, the decrease was also hit by having more limited EDV deliveries this time around.
So it sounds like a strategic pause on older models, maybe focusing resources on the new R1s and getting EDV production sorted.
That seems to be the narrative, yeah. Pivoting resources towards the highly anticipated second-gen R1 and optimizing that crucial EDV production.
And how did this play out in actual production numbers, deliveries? Did those drop too?
They did. Both production and delivery volumes were down. For the 3 months ending June 30, production fell from over 9,600 units last year to just under 6,000 this year. And deliveries dropped from almost 13,800 down to about 10,700. Similar trend for the 6 months. Production down from about 23,600 to 20,600, and deliveries from 27,400 down to around 19,300.
That's a pretty noticeable drop in volume. What's the main reason they give for producing fewer vehicles?
The report specifically calls out supply chain complexities associated with shifts in foreign trade policy.
Ah, the global supply chain gremlins.
Yeah, it really shows you the real-world impact of, global trade issues on even high-tech manufacturing. It's like trying to bake that complex cake, but one key ingredient, maybe a specific chip, is suddenly stuck because of new import rules.
Right, even if you have everything else ready to go.
Exactly. The whole line can slow down. And these lower production volumes, they directly hit the per-vehicle costs. They estimated about $137 million in extra fixed costs in Q2 just because of the lower volume.
Ouch.
But on the flip side, this was partly offset because raw material and component costs actually came down a bit. So you see them adapting to these pressures.
Okay, so while the automotive side saw those fluctuations, the report highlights something else growing really fast, the software and services segment. How big was that growth? What does it suggest?
Oh, it's dramatic, a real transformation. Software and services revenue jumped from $84 million to $376 million for the 3 months ended June 30th.
Wow, that's a huge leap.
And from $172 million to $694 million for the 6-month period. But here's the kicker. This segment went from losing money on a gross profit basis, a $10 million loss in Q2 2024, to making money, a gross profit of $129 million in Q2 2025.
From loss to profit that quickly.
Yeah, and for the 6 months, it went from a $40 million loss to a $243 million profit. This really points to a major strategic pivot. It shows how a car company can also become a serious software and tech provider.
Creating that higher margin, maybe recurring revenue stream?
Precisely. Potentially much higher margins than just building the cars themselves.
So what's the engine behind that transformation, turning that segment profitable?
A huge part of it, really, is the joint venture they formed with Volkswagen Group back in November 2024. This JV is all about next-generation electrical architecture and software. And get this, VW Group plans to use Rivian's zonal ECU architecture and software stack across multiple VW brands.
Multiple brands. So VW sees Rivian as a key tech partner now.
Yeah, they're positioning Rivian as their primary development partner for these specific services. That's a massive vote of confidence and obviously a significant new revenue stream for Rivian.
So this zonal ECU architecture, break that down a bit. Why is that so valuable to a giant like VW? What does it mean for car tech generally?
Okay, yeah. Zonal ECU architecture. Think of it like upgrading a car's nervous system. Instead of a tangled mess of wires for every little function, it groups controls into zones managed by more powerful central computers. This makes things like over-the-air software updates much easier, diagnostics are simpler, adding new features is faster.
So more like a smartphone on wheels in terms of updates and flexibility.
Kind of, yeah. For a company like Volkswagen, getting access to Rivian's already developed, next-gen software stack is a huge shortcut. It speeds up their own EV development, could save them billions in R&D.
Right.
And it really signals that software isn't just a feature anymore. It's becoming the core differentiator and a major way for automakers to make money beyond the initial sale.
And didn't this JV also come with a big chunk of cash for Rivian?
It absolutely did. On June 30th, just at the end of the quarter, Rivian got $1 billion from Volkswagen Group. That was split. $750 million for Class A common stock.
So VW now owns a piece of Rivian.
A significant piece, yes,
Yeah.
which aligns their interests long-term. And the other $250 million was a deferred revenue premium.
Meaning?
Essentially, VW paid an upfront fee for future access to Rivian's tech and services. It's like prepaying for that software expertise, another strong sign of confidence.
Okay, and that made VW a related party.
Correct. Because of the investment and the JV structure. And there's more funding tied to this, a committed $1 billion loan facility from VW to the JV, which becomes available in October 2026. That money is earmarked for Rivian's general corporate purposes.
So substantial backing there. And beyond the VW deal, what else is in that software and services bucket?
Right. It's not just the JV. It also includes revenue from remarketing used vehicles, vehicle repair and maintenance services, their charging network, and software subscriptions. Things like Connect Plus for consumers and FleetOS for their commercial customers, like Amazon.
Got it. So Rivian is clearly not just thinking about today, they're investing heavily in the future.
Yeah.
Let's talk R2 and R3, the new platforms.
Yeah, big focus there. Production for the R2, that's the midsize SUV, is slated to start in the first half of 2026. And to get ready for that, they're planning a pretty significant 3-week shutdown of their main factory in Normal, Illinois. That's happening in September 2025.
A 3-week shutdown, that sounds disruptive. What's the goal there?
It's strategic disruption. The whole point is to integrate the R2 production lines into the existing factory. They're aiming to boost the plant's total annual capacity up to around 215,000 units.
So retooling for R2 and increasing overall output, and this new midsize platform, the MSP, that R2 and R3 will use, why is that so important long term?
The MSP is absolutely crucial for their growth and, importantly, their cost goals. It takes what they learned from the R1 platform, but focuses heavily on simplifying things. Think fewer unique parts, easier assembly designed to seriously drive down manufacturing costs.
Making the vehicles more affordable for more people.
Exactly. More accessible, broader market appeal, and critically improving Rivian's own profit margins down the road.
Makes sense. But expansions like this, new platforms, that takes serious cash. How are they funding all these ambitions?
Yeah, it's hugely capital intensive. They've been busy on the financing side.
Yeah.
Back in June 2025, they issued $1.25 billion worth of new green secured notes due in 2031. They basically used that money to pay off older notes that were due sooner in 2026. So pushing out their debt maturity, giving them more breathing room.
Okay, managing the debt profile. What else?
There's also that potentially massive Department of Energy, or DOE, loan facility. It could be up to $6.6 billion.
$6.6 billion. That's enormous.
It is. It's specifically for developing their next factory complex down in Georgia, Stanton Springs North. But, and this is a key, but getting that money depends on hitting certain conditions and milestones. It's not a blank check.
Right, conditional funding. So what's their cash situation look like right now after all this?
As of June 30th, their liquidity position, which includes cash, short-term investments, and what they could draw from their asset-backed lending facility, stood at $8.519 billion.
Okay, still a significant cushion then.
Yes, but it just underscores the massive scale of investment needed to compete in this EV race. They're clearly lining up the capital for these next big steps.
Okay, but no growth story is ever smooth sailing, right? Especially in EVs. What does the report highlight as the major risks, the roadblocks Rivian is facing?
Yeah, that's a really important question. What are the main headwinds? Well, first, despite the improvements we talked about, like that gross profit break-even, Rivian themselves state they still expect significant expenses and losses for the foreseeable future.
So profitability is still a ways off.
It seems so. And that means they'll likely need more financing down the line, which, could potentially dilute the value for current stockholders.
Right, the need for ongoing capital. What about actually selling the cars? Demand.
That's another key risk area. They explicitly mention needing to improve the order rate for the R1 vehicles. And the whole auto market, especially EVs, is just intensely competitive. Price wars are a real thing. Plus, as a newer company, they admit they have limited experience in large-scale marketing, selling, advertising. Attracting enough customers is a constant challenge.
And we touched on policy shifts. You mentioned legislative changes affecting EVs. How big a risk is that?
Well, government incentives are definitely a source of uncertainty. The report specifically calls out the One Big Beautiful Bill Act, or OBBA, signed July 4th, 2025. Now, we're just reporting what's in their filing here.
Understood.
But it says this act ends certain key tax credits, the 30D for purchases, the 45W for leases for EVs acquired after September 30th, 2025. That could definitely impact consumer demand.
So some key incentives potentially going away soon.
Seems like it, based on the report, though it does note that another credit, the 45X for domestic battery production, remains. So it's a mixed bag on the policy front.
And supply chains, are those still a worry? We heard about the trade policy impact earlier.
Oh, absolutely. Supply chain vulnerability is still listed as a significant risk. Rivian relies heavily on single or limited source suppliers for critical components. Think about it, if that one factory making a crucial part has a problem, or gets hit by a new tariff, or like China restricting rare earth mineral exports.
It can stop everything.
Exactly. It can halt your production line. They even mention a specific example from last year, Q3 2024, where production was disrupted because of a shortage of just one component within their Enduro motor system.
Right, a real-world example of that dependency.
Yeah. And it exposes them to cost increases, too.
Any other major roadblocks mentioned in the filing?
A few others stand out. Regulatory and legal hurdles. Their direct-to-consumer sales model still faces fights in some states with traditional dealer laws, and they mention ongoing lawsuits, like securities class actions. Then there are the technology and safety risks. With complex software and hardware, there's always a risk of errors, bugs, potential recalls, and, of course, the inherent safety considerations around lithium-ion batteries.
Standard risks for the industry, but important.
Definitely. And finally, their relationship with Amazon. Right now, a huge chunk of their automotive revenue comes from those EDVs for Amazon. But the agreement is not exclusive. So there's a risk if Amazon decides to buy fewer vans or buy from someone else too.
Right, dependency on a single large customer. Understanding all these risks, it really helps you see the full picture, doesn't it? Not just the exciting announcements.
It does. It shows the complexity of trying to scale up a company like this in such a dynamic, challenging industry.
So, pulling it all together, what does this deep dive tell us about Rivian and maybe the wider EV market? It really feels like a story of, well, ambitious growth, some key strategic partnerships.
But also navigating some very real financial and operational hurdles. Hurdles that are pretty common when you're trying to pioneer a new space like this.
Yeah. To reinforce that, Rivian is clearly making progress, improving financials, securing its future with new products, that VW partnership.
That gross profit break-even for the half year is genuinely a big step. It shows they can build the vehicles more efficiently.
Yeah.
But, yeah, it's still very much a growth stage company. They face substantial risks. They need ongoing investment to really achieve that long-term vision they've laid out.
So for you, our listener, here's something to think about. How might Rivian's big bet on software and services, especially through that Volkswagen JV, reshape things? Not just for Rivian, but for the whole traditional auto industry.
Yeah, that's the provocative question, isn't it? Will software ultimately be the main differentiator for EV makers? Maybe even more important than the physical vehicles themselves in the long run?